big story of the day, Dow Jones Industrial Index back above 13,000. Although, I should note, it is no longer above 13,000. To discuss the market more generally, Barron's associate editor Michael Santoli is now striding onto the set. The part that you had a piece this weekend, you know what the part I like the most out of this, Mike?
Can't imagine.
Well, the part here where you point out that that of the Barron's, the year-end 2012 forecast for your 10 Wall Street strategists, you know, these are the guys that get paid all the big money to tell investors what's actually going on and where the market's going to go. They all apparently have gotten it wrong because they hit their target within the, the first 6 weeks of the year.
Either they've gotten it wrong or they've gotten it prematurely right.
You give them, them too much credit, Mike.
No, I do. That's boiling it all down. Look, I always joke that those guys practice the art of the plausible.
Right.
Right? It's like politics, the art of the possible. It's the art of the plausible. It's like, okay, where can we see this thing going?
Right.
You know, I'm basically going to be walking into client meetings where half of them are going to be bearish, half of them are going to be bullish. Let me go right down the middle.
How do I end the year and make sure I can say, well, I was right for part of the year,
and
so
I didn't make too many enemies on the way. Yeah, exactly. Look, the market has been a gentle upward ride for like 8 weeks now. So I don't think a lot of us saw that.
This is about as good as it gets, though, in terms of the news flow, in terms of the way the market's gone up, not on very heavy volume, not erratically or dramatically, kind of edging up, 5 or 6 points on the S&P, seems like every couple of days.
Right. It seems like the default mode is obviously it wants to lift higher if nothing gets in its way, and nothing has really gotten in its way right now.
Right. Yeah. Now, talk a little bit about earnings, because earnings, we believe, I think you're in this camp, that earnings at the end of the day drive the market. Sure. Not a lot of expectations for significant earnings growth this year, and the market doesn't really seem to care.
It doesn't. It's interesting because last year, of course, earnings were gangbusters and the market kind of was flat. So you had this sort of coiled spring effect. And I do think that you have to really pick through the industries to figure out where the earnings are. And I think what the market is doing now is it's gravitating toward those areas that have sustainable earnings growth, right? Everyone's doing the whole game of there's two markets. There's the market with Apple and without Apple, right? So you take Apple out, it's really pretty pedestrian earnings growth, if any. But it's coming in the areas of those traditional growth stocks that we've through the years been trained that can get it done. So I really feel like the market is not going to be constrained by valuations here, but it's also not the reason to buy the market here because you have to have that economic news flow that remains positive.
And yet, if we look at alternatives, and this is the favorite argument, I saw Jeremy Siegel was on CNBC. He's been making this argument for years. I happen to buy into the argument, but again, that's just me. Which is, if you look at the earnings yield, in effect, the inverse of the PE, you're at an earnings yield of over 7%. Which gives you a 500 basis point cushion before you have to get down to the Treasury. I mean, that is a huge gap.
I'm a little bit skeptical of that particular equation, and mostly because it only ever worked for a discrete period of history, right? Basically from when interest rates were in secular decline. So basically from the early 80s, 20 years on, it worked. Now, that doesn't mean that the absolute earnings yield is not attractive. I actually think it is, right? So 7% earnings yield, I don't feel like I have to compare it to an artificially depressed Treasury yield to say that gives you a margin of safety in equities.
Right. Let's talk a little about retail investor flows. There's been some data coming out, sort of hearkening back to the data that we had in April of last year, right before the market took a big leg down, that retail money, or maybe it's not purely retail, but domestic equity funds flows had turned strongly positive in the last couple of weeks.
Yes.
Do you think we're going to continue to see that, and do you think that necessarily is a harbinger of bad things to come for the market?
I don't think it's just too easy to say, oh, well, there's your contrary bearish signal. I don't really think that's the case. But what it does require is that the market remains relatively calm. The market remains, kind of with an upward bias for that money to continue to flow through. Because I do think, we've been 5 times burned, right? So how many times cautious are you going to be after that? So I do think if we're going to see a wholesale rotation from fixed income into equities, we have a really long way to go. But it's too early to say that that's really the process that's started right now.
When do you think all the investors who've been dumping out of equity funds or equities over the last few years, pouring money into bond funds, when do you think they stop pouring money into bond funds, or when do you think they freak out because bond yields start backing up on them? Do you think that we still have a ways to go? I mean, I noticed today that the 10-year was back over 2%. It's not up by much, maybe it's 203, 204. But one of these days, are we going to wake up, there's going to be a 230, a 240, and people are going to freak?
I kind of don't really want to predict that that's going to happen overnight. I do think, by the way, what people are really doing is not putting money in an active way into Treasury. What they're basically doing is putting into investment-grade bond funds. So they're basically buying high-grade corporate bonds, which to me are not going to kill you. Right? They're kind of just enough to get by. So I really think it's going to take higher stock prices to make people feel silly for being underinvested in equities. If that's going to happen, that's what it's going to take. It's not just going to be a revelation. It's going to be because the market dictates.
Right. The pros, the investment pros, they've gotten it wrong pretty much over the last 2 years, right? Why does Barron put out these pieces where they tout what these people are saying, when year in, year out, it turns out that the received or the conventional wisdom always seems to be a little wrong?
Actually, 2010, they precisely nailed it by dumb luck, right? But I'll tell you the real reason we do it. I honestly think it's because it sets the context for what everyone's kind of looking for the market. There's some value in knowing what the consensus thinks, and maybe we should probably do a better job of saying, look, this is all this is for. It's not really a prediction.
Right. Yeah. Do you think we're going to see some of the more bearish folks out there, like the David Costin at Goldman's, or I think it was Adam Parker over at Morgan Stanley? Are they going? Do you think that we're one of these days, probably sometime soon, they'll put out a note going, we've changed our forecast.
If I had to bet, it would be Goldman. But, I saw a quote from Adam Parker at Morgan Stanley today where he said, last year in April, people kept emailing me, my clients kept emailing me saying, when are you going to raise your targets? When are you going to capitulate? And he says, I'm starting to get that again. So I'm a little bit cautious tactically right now. I feel like, it's not the most wonderful entry point, but I wouldn't really wait and vigil for that.